On July 8, 2026, roughly 8 lakh crore rupees of investor wealth simply vanished in a single trading session. This chart captures the speed of the decline. By the closing bell, the BSE Sensex had dropped nearly 1,700 points to settle at 76,503, while the broader Nifty 50 plummeted over 516 points, down to 23,882. The selling was aggressive and indiscriminate. Investors rapidly reduced their equity exposure, pushing heavyweights in banking, IT, and auto firmly into the red, while mid-cap and small-cap stocks saw equally heavy liquidations. If you were staring at a portfolio filled with bleeding sectors that afternoon, it would be logical to assume that the core domestic economy was failing. Although the losses appeared on local screens, the cause originated thousands of miles away, the final stop in a geopolitical domino effect. The initial catalyst occurred in the Middle East. Rapidly escalating political and military friction between the United States and Iran put the region on high alert. Financial markets operate on a demand for predictability. When the threat of a localized dispute spilling over into a wider regional conflict materializes, institutional investors immediately begin pricing in the worst-case scenarios. In this specific region, the worst-case scenario means a direct physical threat to the global supply chain of crude oil. The immediate concern is military action bottlenecking the energy required to keep the global economy moving. We can track that specific fear directly through commodity pricing. This chart shows the movement of Brent crude oil reacting to the geopolitical tension. Prices jumped up by over 6% in rapid succession, pushing a single barrel to around $79. A regional political conflict quickly weaponizes the global commodity market. It creates a trap that severely penalizes any nation highly dependent on imported energy. This map highlights India's vulnerability. Importing most of its crude oil directly exposes it to price shocks. At $79 a barrel, the import bill expands immediately. Surging transport costs drive domestic inflation, shrinking corporate profit margins and pushing down overall economic growth. When institutional investors dumped their shares on July 8th, they were doing it to avoid holding domestic equities through a projected cycle of high inflation and slowed growth. The panic forced traders to reassess inflation risks across other asset classes. Bond yields climbed rapidly, and the Indian rupee weakened against the US dollar. Ultimately, the Nifty crash functions as the final visible symptom of a global oil shock aggressively repricing India's economic future. Navigating the immediate fallout requires looking entirely outside domestic borders. Traders will be heavily monitoring military developments in the Middle East, the trajectory of crude oil, and the resulting inflow or outflow of foreign institutional investors. Domestically, the technical focus shifts to this chart. The immediate test is whether the Nifty index can successfully hold its support zone between 23,800 and 23,900, or if the market faces further downside. However, your reaction to that technical data depends entirely on your timeline. While day traders have to navigate severe unpredictability, an investor with a 5 to 10-year horizon operates under a different psychology. When viewed over a decade, a single trading session that erases 8 lakh crore rupees is simply standard, externally driven market volatility playing out during a political crisis. Experienced investors rarely try to predict the exact bottom of these events. They allow the dominoes to finish falling and use the broad-based fear to systematically accumulate shares in quality businesses at a steep discount.